Welcome back to the Precision Portfolio, where we dissect the strategies shaping the future of finance. I'm your host, Alex, and today we're diving into a topic that often feels like science fiction, but is now absolutely critical to the crypto market: cryptocurrency trading bots. We're not talking about magic wands, we're talking about sophisticated tools. Joining me to demystify this is Maya, a seasoned algorithmic trading expert and founder of Insight Algos. Welcome, Maya.
Thanks for having me, Alex. I'm excited to pull back the curtain on this. The term bot sometimes makes people feel like they're surrendering control, but really it's about optimizing control.
That's a great distinction. Let's start with context. Why do we even need bots in the first place? In the uploaded guide that we're basing our discussion on, the author talks about the speed challenge. Can you elaborate on that? Why can't a human win this race?
It's pure physics, honestly. Imagine an opportunity, say a tiny price difference or a trend signal that appears and vanishes in 1/10 of a second. A human investor, no matter how quick, takes what? 5 seconds to look at the chart, confirm the news, and execute the trade?
Right, those 5 seconds are consumed by cognitive processing, clicking, and network latency.
Exactly. In that exact same 5-second window, an automated bot has executed thousands of buy and sell orders. In the decentralized 24/7 crypto market, speed is the currency of trading. If you want to exploit small market inefficiencies, you simply cannot do it manually. The bot is the materialization of financial discipline and raw speed.
So it's not just about being faster than other humans, it's about being faster than the closing window of opportunity.
Precisely. And that leads us to the biggest advantage: the elimination of the emotional factor.
The emotional factor, the fear and greed that plagues every human trader. How does a bot serve as the ultimate countermeasure to our psychology?
A bot is programmed to adhere to a plan. When Bitcoin drops 10% in an hour, what we call a flash crash, a human feels panic. They might sell at the bottom out of fear, or they might buy too much out of euphoria if the price is soaring. A bot experiences no palpitations. It simply checks, does this price meet the stop-loss rule? Yes, execute trade. It's pure, cold, mathematical logic. It's the ultimate expression of your predefined rational strategy.
That's a brilliant way to put it. Now let's look at the flight plans. The source material outlines some key strategies. Let's start with arbitrage. That sounds like the most straightforward application of speed.
It is the purest hunt for inefficiency. Arbitrage exploits the fact that due to market decentralization, the same coin, say Solana, might be priced slightly differently on Binance versus Kraken at the same instant. A bot detects that difference, buys on the cheap exchange, sells on the expensive one, and pockets the micro profit, minus commission.
It's the closest thing to printing money, but it's a high-stakes game of latency, isn't it?
Absolutely. These opportunities close instantly. Only the bots with the lowest latency, the fastest connection speed, survive. It's a game for the precision engineered.
Okay, next up, a strategy that's more about volume, market making.
Market making is fascinating. It acts like a financial auctioneer. The bot aims to profit from the bid-ask spread, that tiny difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. The bot simultaneously places a buy order slightly below the current price and a sell order slightly above it.
So when both orders are filled, it captures that little margin in the middle.
That's it. Think of it less like trying to catch one massive fish with a rod, that's directional trading, and more like casting a wide fishing net that continuously catches small, numerous fish. It's high volume, low profit per trade, and requires high liquidity to work well.
That analogy is perfect. And finally, the one I think many beginners look at, grid trading. This is for when the market isn't clearly going up or down.
Right. Grid trading is your go-to strategy for a sideways or ranging market, when the price is bouncing between defined high and low points. The bot establishes a grid of buy and sell orders at preset intervals. When the price drops to a lower line, the bot buys. When it rises to a higher line, it sells. It automatically buys low and sells high within that specific range.
It sounds less aggressive than arbitrage. It's basically exploiting volatility within a box.
That's spot on. The main risk, as the guide highlights, is when the price breaks outside the defined grid range. If it drops dramatically, your bot is left holding a lot of purchased assets. Or if it shoots up, it sells off too early.
Okay, this all makes the human trader sound obsolete, but the guide insists the future is a hybrid synergy. Where does the human factor transition from being the emotional executor to the necessary manager?
It shifts the investor's role from a participant to a commander-in-chief. The human is superior in 3 key areas where the bot fails. First is adaptation to unpredictable events. A bot cannot read the news that the Federal Reserve is about to hike interest rates or that the SEC has just sued a major exchange. Those are macroeconomic events that require human judgment to say, stop the machine.
So external black swan events.
Yes. Second is regime change detection. A human can detect when a prolonged bull market is fundamentally changing to a bear market or vice versa. The bot only sees technical indicators based on past performance. The human manager has to decide this strategy is now obsolete. Deactivate it.
That's the difference between tactical execution and strategic vision. The bot does the tactics perfectly, but the human sets the strategy.
Practical application tips and risk management.
For a listener who's feeling ready to try this, what are the non-negotiable practical steps they must take before risking real capital?
There are 2 vital steps, and you must do them in this order. First is backtesting. Apply your strategy to historical market data. See how it would have performed over the last year. This is your financial flight simulator.
Second, paper trading or simulated trading. You run your bot using virtual money in real-time market conditions. Backtesting tells you if the logic should work. Paper trading tells you if the logic does work in the current chaotic environment. Don't skip the practice exam.
Right. Once they feel confident in the strategy, how do we establish a risk management plan? Because automation does not eliminate risk.
Absolutely not. It actually makes risk management more vital. You need a handbrake for the robot. We recommend 3 non-negotiables. Allocated capital. Never assign more than 10% of your total investment capital to a single unproven bot. Global stop loss. Every bot needs a clear maximum drawdown limit. If the bot loses 50% of the allocated capital, it must automatically stop all operations. You define the ruin scenario, not the bot. And API security. This is critical for trust. When you link the bot to your exchange via API keys, those keys must be limited to trading capacity only. Never ever grant them permission to withdraw funds. That is a non-negotiable security measure.
That last point is huge. The risk is manageable, but only if the human manager enforces those hard limits.
Let's briefly touch on the dangers. The guide warns against the miracle bot myths. What is the most common false belief?
The biggest myth is set and forget. It's a total fantasy. A bot's parameters degrade over time. The strategy that performed perfectly during a bull run will lose money during consolidation. Constant calibration is the key to survival. If a platform promises guaranteed profits, run the other way. It's likely a Ponzi scheme trying to exploit your desire for passive income.
And the technical danger of a flash crash.
That's where the stop loss saves you. A flash crash is a sudden, massive drop, often caused by the cascading liquidation of other large orders or bots. If your bot is programmed to automatically buy the dip without a tight stop loss, it can quickly deplete your capital in a downward spiral. The human must define when the machine must stop buying.
Kalumaya, this has been incredibly insightful. Let's bring it all back to that hybrid future. We need the bot for its efficiency, speed, and discipline, but we need the human for strategic oversight and risk judgment.
That's the summary. Automation is not a shortcut to wealth. It's the mastery of efficiency applied to your existing financial strategy. Your human brain handles the macroeconomic risk, and the bot handles the microsecond execution. That synergy is unstoppable.
So for our listeners, the actionable takeaway is this. Set up a paper trading bot today. Test your strategy, measure the results with rigor, and see how the market reacts. Practice without risk first.
Exactly. Get comfortable being the commander.
Maya, thank you so much for sharing your expertise today.
My pleasure, Alex.
And thank you all for listening to the Precision Portfolio. We'll catch you next time.